really rapidly. I'm going to kick off as soon as this webinar. And it is my absolute pleasure to welcome you this morning to the second seminar of the academic seminar series promoted by Consob and Università Sapienza di Roma, in particular the Faculty of Economics. So let me first of all give the floor to Professor Fabrizio D'Ascenzo, Dean of the Faculty.
Okay, thank you very much, Marina. Welcome everybody. I'm very glad to be here, even if virtually, but I hope that very soon we will turn these occasions in real meetings. I understand that this is simple because we have the chance to connect everybody, but as Dean of the Faculty, I really hope we will be able to join all students and people together in a room. Anyway, let me congratulate the organizers of this interesting conference, because this is the second part of a cycle of seminars organized in cooperation with Consob. We really care about this cooperation with Consob because it is an added value for our faculty. And we believe that this is a very good experience we can provide to all our students, especially to international students, but I know that plenty of them are Italian students that are willing to participate to conferences in English language. And this is certainly a good occasion for them. You know, we have a nice number of master courses which are taught in English language only. But I saw that even students coming from Italian language courses are more and more willing to participate to these international seminars. So it is a good occasion to thank Professor Broggi and even Professor Strangio, who is the faculty delegate for internationalization, that are giving really their best in order to provide these very important occasions to our students. So I will conclude my little speech here because I want to leave the floor to our important hosts. And thank you very much for inviting me. As I told the organizers, in a half an hour I will be forced to move to another conferences, but as soon as I will be there, I will certainly listen with the maximum attention the speeches of our guests. Thank you very much. The floor returns to Professor Broggi.
So thank you very much, Fabrizio. Thank you very much for your kind words. Let me immediately pass the mic, virtually pass the mic to Professor Mosca, who is Consob Commissioner and who is the person who is following the numerous projects that Consob has regarding ESG, which is today's topic. Thank you very much, Chiara, for being here.
Thank you very much to you, Marina, and good morning to all. I am very glad to welcome you at today's seminar. I am an academic, and I would also like to say that in my life, I've always loved a lot paper presentations because they allow to present very interesting research and to analyze them in depth. And for this reason, today I'd like to stay with you for the 2 hours and to listen to all the speakers. Okay, as we all know, ESG topics have been growing in importance in financial markets in the last years, and sustainability is at the core of the regulatory agenda. The mission of Consob is to enhance investor protection, something that we all know, and to promote stable and orderly financial markets. One of the key tools is to foster transparency and correct information on financial markets. As always, with regards to sustainability, transparency and information is central. They are central, and this is not new. This is the same old story of financial information. For decades, regulators, academics, practitioners have been working together to improve quality and comparability of information within the corporate governance framework, where information is the very first tool to assess the business model of corporations. Transparent and reliable disclosure rules are the first important step to support the EU strategy for transition to sustainable economy and to channel financial resources to the relevant economic activity. On the regulatory side of the story, let's put it this way. Just in the last 3 years, there is a number of initiatives that have been adopted by the EU. Just to name the most important ones. The Sustainable Financial Disclosure Regulation, the Taxonomy Regulation, the proposal for a Corporate Sustainability Reporting Directive, and very recently, the proposal for a directive on corporate sustainability due diligence. The other side of the story is the market side. Markets are growing significantly in the field of sustainability. There are new sustainable products, they emerge, and also the demand of investors is increasing. So I say that there are some main challenges that can be identified with regard to sustainable finance. First of all, the fast evolving regulatory framework. There are multiple initiatives from the European legislator. At the same time, initiatives from the supervisor and from the standard setter. Some are already live and some are still in the making. All these create a lot of complexity and a lot of cost for the companies. Always there is a sort of a risk of divergence in the application of rules, and these can undermine the smooth function of the markets. Second, the growing demand of ESG investment. If the demand is not coupled by adequate transparency on the real sustainability of the financial progress, there is a risk of misrepresentation of sustainable information and, of course, a risk of mis-selling of financial products. The problem is the unreliable ESG labeling that may lead to a loss of trust in the demand. Third, a risk of misalignment between the investor preference on ESG and the products that are offered by a financial intermediary. And here the role of financial regulation may be also important. The last problem is the, let's say, the supervisory capacity, because if the framework is so evolving so fast, it's very difficult for supervisory authority to do it, because we need to build a lot of different capacity that are not the traditional capacity. I would like to mention that we need to have a good knowledge of the relevant regulation, but this is not enough. We need to understand how to embed the new regulation requirements in the traditional supervision model, and this requires new skills and new tools that must be acquired very soon. For this reason, from the very beginning of this new wave, Consob established a steering committee on sustainable finance that I'm here to represent today. The task is to understand ESG topics across many different angles. We have adopted an horizontal approach given the cross-cutting relevance of the topic, and we also like to promote the debate and research on the area of sustainable finance, and we wish to increase the dialogue with the academy and with market participants. So my presence today at this seminar witnessed the importance for us of this interaction with the academy and with all the researchers that are involved in the field. So basically, I would like really to conclude just these few words to say that in this general framework that I have described very shortly, today's papers are very promising, and I very look forward to assist to today's discussion. So thanks again.
Well, thank you very much, Chiara, and Professor Mosca, I should say, actually, more precisely. And it's very reassuring to know that Consob has this truly important topic very much top of mind. And just before I lead in to today's discussion, just a couple of words on the academic seminar series promoted by Consob and Sapienza, and then just remarks on today's presentations. Now, the New Frontiers in Financial Markets and Regulation, which is the name of this academic seminar series, has the objective of promoting, as Professor Mosca so clearly identified, an interaction between academic thought, academic research, rigorous research, and then regulation and ultimately improvement in what companies do and how they address in the main challenges that I have to face. Today, we're going to be speaking about environmental, social, and governance factors. And some of you may recall that in the very first seminar of this series, we are planning to organize 3 or 4 a year for each academic year. We spent some time on emerging risks in cryptocurrencies. We had a very insightful keynote speech by the chairman of Consob, Professor Savona, which I encourage the many students who are here today, who may not have been able to attend the seminar. You may find Professor Savona's speech in the Consob website, and actually I strongly encourage you to refer to all documentation which will be uploaded on the Consob website regarding these seminars, which I think is very, very useful for all students. Another small housekeeping point before I forget is that students who want to attend the seminars as part of their academic career need to join with their name and surname. We have a number of people who have registered without identifying themselves. So I encourage them to log off while I say my residual remarks and re-log in with their name and surname so that we can actually map them. And sorry for this housekeeping detail for the rest of you. Now, again, let me pass on to my remarks regarding today's topic. And let me welcome you all also on behalf of the scientific committee. With the scientific committee, we've been working, and we felt that today's topic, which is ESG factors and climate risk, is very, very timely. Actually, you may have realized that hot off the press, we would say, last night there was the latest proposal for climate and sustainability reporting standards from the International Financial Reporting Standards Board. So none of us have had the opportunity to really do a deep dive because it was yesterday. And the week before, the SEC came out with regulations, or proposed regulations, I should say, regarding how disclosure should be for listed companies. We know that Europe has a much stronger position. Europe is leading everybody is leading the way regarding ESG, regarding sustainability. And without any further ado, let me pass the word to Lucia Alessi, whom I thank very, very much, because she's going to provide us with insight relative to what the European Commission has in the pipeline. And we are particularly proud to be European, because it is absolutely true that the Commission is leading the way. The SEC has now tagged along. We have the new reporting standards. This is a topic that I think we will continue to follow because, you know, history is in the making, as they say. But let me please pass the word to Lucia Alessi for her introductory speech regarding the Commission's position on sustainability. Thank you very much, Lucia. The floor is yours.
Thank you, Marina. Thank you very much. I would like to apologize because today I don't feel very well. So the presentation might not be super brilliant. In fact, it would be already a success if I managed to go to the end of the talk, but I'm confident. All right, so I'm leading financial research at the Joint Research Center of the European Commission. At the JRC, we do science for policy. And in fact, the talk that I'm going to give today is a 100% policy talk on the strategy for financing the transition to a sustainable economy that the Commission launched in July 2021. Now, let me try and share the presentation. Now you should see it full screen, hopefully.
Indeed, I can see it perfectly. Thank you.
Can you? Okay. Okay, so this is what I meant. All right. So what are the foundations of the sustainable finance framework that we have in the European Union? The cornerstone of the framework is the EU taxonomy for sustainable activities, which is a classification of economic activities that substantially contribute to environmental objectives. The taxonomy is like a dictionary, and indeed the piece of legislation containing the criteria based on which we define an activity as green is several hundred pages long. So this is essentially the basis for several other actions and policy initiatives related to sustainable finance. The taxonomy is structured around 6 environmental objectives, and so far it has been developed in relation to the objectives of climate change mitigation and climate change adaptation. And for those objectives, there is already a large number of activities for which so-called technical screening criteria exist. So one can go and check in this big dictionary for a particular economic activity and look what are, for example, the emission thresholds or the thresholds in terms of energy efficiency that characterize greenness in that particular sector. Then there are disclosures. That is a comprehensive disclosure regime for non-financial companies, for financial institutions, for financial market participants that aims to provide investors with the information that's necessary to them to make informed, sustainable investment choices. And as it was mentioned already by Professor Mosca, parts of this disclosure regime are the Sustainable Finance Disclosure Directive that's already that applies already since March last year, while the details, the Level 2 regulation will apply as of the beginning of 2023. The Corporate Sustainability Reporting Directive, which is to replace the Non-Financial Reporting Directive, and this is currently under negotiation by the co-legislators. And there are other pieces of legislation that have been already adopted. For example, under the taxonomy regulation itself, there are some disclosure requirements for non-financial and financial corporates. So that apply already as of this year. And then there are the tools, meaning financial instruments, for example, that companies and market participants, investors, banks, insurers can use to develop their sustainable investment strategies, and also preventing greenwashing. For example, we have a new climate benchmark regulation already since 2 years, and the Commission adopted a proposal for the so-called EU Green Bond Standard. So green bonds exist already, as you know, but green bonds may be issued under different certification schemes that adopt different definitions of green, or may be issued under no certification scheme. So in that case, we need to trust the issuer that the company will use that money for green activities. Sometimes we don't really know much. Now, green bonds that will be issued under the EU Green Bond Standard will need to comply with some requirements, including that 100% of the proceeds will need to be used to finance taxonomy-aligned activities, so activities that are green based on the definitions of the taxonomy. And also there will be reporting requirements and verification carried out by verifiers that will be certified by the ESMA. All right, so these are the foundations of the framework. And in this context, the Commission launched a so-called Renewed Sustainable Finance Strategy in July last year, which is part of the European Green Deal. And I would say, I mean, from my perspective, one of the most important parts, because without financing, you cannot really do much. This basically follows up to the action plan on financing sustainable growth that the Commission launched in 2018. The European Union was as Marina said, has always been leading, in fact, on sustainable finance. This strategy that will basically shape the work of the Commission for the next years is structured around 4 key action areas. One has to do with financing the transition to sustainability, and this has to do with the tools and the policies that enable economic actors to finance their transition plans. And this, for example, has to do with the taxonomy, further development of the taxonomy, and the development of other tools, maybe similar to green bonds, also, for example, green loans or sustainability bonds. So basically to broaden the toolbox. The second area has to do with inclusiveness. Essentially to provide opportunities to individuals and SMEs to have greater access to sustainable finance. The third area has to do with the financial sector and is twofold. On one hand, it basically aims to foster the contribution of the financial sector to meeting the Green Deal targets. And on the other hand, it aims at enhancing the resilience of the financial sector to shocks that are related to, for example, climate change or and other environmental and social risks. And finally, there is an action that's related to the global dimension, meaning promoting an international consensus for an ambitious sustainable finance agenda at the global level. Now let's go a bit deeper into these actions. The first one is developing a more supportive framework for the financing of intermediary steps that can significantly reduce harmful climate and environmental impacts. This action is essentially about further developing the framework and the tools to cater for transition finance needs. So transition is the key word here, both in terms of extending the underlying framework, as I said, the taxonomy, and also in terms of developing financial standards and labels that could be needed by the market. And in particular, the Commission will consider proposing legislation to support the financing of certain economic activities, primarily in the energy sector, including gas, that contribute to reducing greenhouse gas emissions in a way that supports the transition. The Commission will also consider options for an extension of the taxonomy to possibly recognize economic activities that are not green, because they are not good enough in terms of their environmental performance. For example, the level of emission is still too high, but they are also not too bad. So they are not significantly harmful to the environment. They perform at an intermediate level. And why so? Because this could help to mobilize finance for activities that are not yet green, but that are on a credible pathway towards becoming green. And a report on how this extended taxonomy could look like has been just published by the Sustainable Finance Platform, which is an expert group set up by the Commission that is working on sustainable finance. And then the Commission has adopted a so-called Complementary Climate Taxonomy Delegated Act that covers activities that were not covered in the Delegated Act that was adopted last year, notably nuclear and gas. And this is currently under the scrutiny of the co-legislators. And finally, with respect to the further development of the taxonomy, the Commission will adopt another delegated act that covers the remaining 4 environmental objectives. So on top of climate change mitigation and adaptation that are already covered to a large extent, the other objectives that will be covered are water, biodiversity, pollution prevention, and circular economy. A report by the Sustainable Finance Platform with proposals for technical screening criteria for these additional 4 objectives has also just been published. With respect to the second action, this has to do with improving the inclusiveness of sustainable finance, which is essentially reaching to citizens, SMEs, and providing better access to sustainable finance opportunities. So this is also about better protecting citizens, for example, by offering greater insurance protection from climate and environmental risks. The Commission will ask to the EBA an opinion on innovative instruments such as green loans and green mortgages. There will be actions related to financial literacy and investment advisors, and tools and advisory services for companies, especially for SMEs. And then finally, there will be actions aimed at supporting green budgeting and risk-sharing mechanisms, and also to support credible social investments. And in this respect, the Commission will publish a report about the merits and feasibility of a social taxonomy, which will largely draw on a report that, again, the Sustainable Finance Platform has recently published. Now, with respect to the financial system, there are several actions. There are actually 3 actions. And an important concept here is the double materiality approach. And this is also very relevant in terms of accounting principle, in fact. So the double materiality approach, which is something that's very close to the heart of the European Commission, consists of the systematic integration of both financially material sustainability risks, which capture the outside-in perspective, and sustainability impacts that capture the inside-out perspective in financial decision-making processes. So the idea is that both these angles of the materiality concept should be integrated for the financial sector to contribute proactively to the European Green Deal. In terms of concrete actions, Action 3 has to do with enhancing economic and financial resilience to sustainability. So, for example, with respect to financial reporting standards and credit ratings, the Commission will work with the European Financial Reporting Advisory Group, the ESMA, and the IASB on how financial reporting standards can capture relevant sustainability risks, and also take action to ensure that relevant ESG risks are systematically captured in credit ratings in a transparent manner. With respect to banks and insurers and how they should identify and manage sustainability risks, in the review of the CRR-CRD, the Commission has proposed binding requirements and mandates for the European Banking Authority for the integration of ESG risks in the risk management rules for banks, and also required the supervisors to ensure that banks manage ESG risks adequately, reflecting the different types of ESG risks. And in particular, this will also include improvements and a new mandate for the EBA to issue guidelines as regards indeed identification, measurement, management, and monitoring of ESG risks. The Commission also proposes to explicitly empower supervisory authorities to incorporate ESG risks in the supervisory review and evaluation process. And banks themselves will be required to conduct internal stress tests to test their resilience to climate change risks and long-term negative impacts. And the EBA will need to issue guidelines on these too. And with respect to risk differentials and capital requirements, the Commission proposal is to recognize that measures to enhance energy efficiency of a mortgage collateral can be considered as unequivocally increasing property values. And in this respect, the Commission proposed to bring forward to 2023 from 2025 DBA's mandate to assess whether a dedicated prudential treatment of exposures that are related to green assets would be justified. So this means kind of a green supporting fund. And finally, with respect to managing sustainability risks at the system level, what we want to do is to strengthen long-term financial stability through a closer cooperation on financial stability risk assessment, through regular stress testing, through the assessment of the macroprudential toolkit, and also to broaden the perspective not only to climate change, but to also environmental degradation and biodiversity loss. Another action that has to do with the financial system has to do with increasing the contribution of the financial sector to sustainability. With respect to improving science-based target setting, disclosure and monitoring of the financial sector's commitments, the Corporate Sustainability Reporting Directive, as I said, the proposal for it has been already adopted by the Commission and is now under negotiation. the European Financial Reporting Advisory Group has already published a draft proposals for reporting standards. And with respect to the Sustainable Finance Disclosure Regulation, the final draft regulatory technical standards, so the level 2 regulation, so the details of which key performance indicators and what information will need to be disclosed, this has been published by the European supervisory authorities in October 21, and the next step is for the Commission to adopt these regulatory technical standards in one delegated act anytime soon, I would say. With respect to sustainability pledges, this is inspired by UNEP-FI initiatives. So essentially, the Commission will examine to what extent more guidance could ensure that such voluntary pledges are credible and will monitor, and the Commission will monitor progress over time and across the EU. At this stage, however, the financial institutions could already use the EU taxonomy and other sustainable financial tools to progress towards achieving their plans at entity and at portfolio level, so at the level of the product. With respect to clarifying the fiduciary duties and stewardship rules of investors to reflect sustainability impacts, here we will ask for the help of EIOPA to assess the need to review the fiduciary duties of pension funds and investors. And with respect to the Shareholder Rights Directive, the Commission will explore how it could better reflect impact considerations. And finally, there will be policy actions to improve the availability, integrity, and transparency of ESG market research and ratings. Another action, again, that has to do with the financial system has to do with monitoring an orderly transition and ensure the integrity of the EU financial system. So on the one hand, this means addressing greenwashing, so monitoring greenwashing risks, and assess whether the current supervisory and enforcement toolkit is adequate for doing this. And with respect to the orderly transition, here we will work together with member states and strengthen the cooperation among all relevant public authorities. And finally, an action that is very close to my heart, because the JRC will be leading on this, is the establishment of a sustainable finance research forum to actually foster knowledge exchange between researchers and the financial community. So I am particularly happy I'm talking to this audience today because I think it's very well targeted. So finally, the last action, as I said, has to do with setting a high level of ambition in developing international sustainable finance initiatives and standards, and to support EU partner countries. And what does this mean in practice? Suggesting, for example, to expand the mandate of the Financial Sustainability Board to integrate the double materiality perspective, which, as I said, is very important for the European Commission. Advance and deepen the work of the International Platform on Sustainable Finance. So this is a multilateral forum of dialogue that currently includes 17 members, accounting for 55% of global emissions and global GDP, and half of global population. And the proposal is to expand the work of the IPSF to new topics, for example, biodiversity. And finally, there will be support to low and middle income countries in scaling up their access to sustainable finance. And in this respect, the Commission has recently launched a call for experts for a dedicated high-level expert group to identify challenges and opportunities in partner countries, on the one hand, and to also provide recommendations on how to accelerate private green financial flows to those partner countries. So yeah, to conclude, based on the action plan on sustainable finance from 2018, the Commission has taken unprecedented steps to establish the foundations for sustainable finance. And this strategy sets how the objectives of the European Green Deal are translated throughout the financial system. These policies build on the Commission's collaboration and partnership with external private and public initiatives to foster financial sector leadership towards achieving the EU sustainability goals. And the Commission will report on this strategy's implementation by the end of 2023. Thank you for your attention. I managed to get to the end of the presentation.
Thank you very much, Lucia, for accepting our invitation to deliver this very comprehensive and detailed policy speech. We are all acquainted with your excellent research on environmental, social and governance and climate, but I must say I'm very impressed with the way in which you gave this really comprehensive, and there's so much going on in Europe that it is a daunting task. So thank you very, very much for being with us, and we look forward to having you as a speaker presenting some of the JRC research on this topic. Now, as you mentioned, and actually as you clearly highlighted in your speech, there are many areas in which the Commission expects help from the financial sector. And today's presentations, we have two interesting papers. I think interesting. I disclose my conflict. I'm co-author to one of them, which is devoted to the use of ESG factors in credit risk, and the other is instead a complementary view, which is based on how capital markets integrate ESG factors and climate risk, especially within stock prices. So we have both areas, the banking area, more traditional, and in certain countries in Europe, more important. And then we have also the capital markets angle, which will be presented in our second paper presentation. I must say, some of you who said they would join the seminar, we have an inversion in the topics. It should have been first the capital markets paper and then the banking paper. We have inverted, and so I will leave the word to Valentina Lagasio, who will illustrate the paper, and I leave the floor to her, and then we will have this discussion of Professor Giuseppe Torluccio, who's full professor of banking at the University of Bologna. So welcome to both our presenter and our discussant, and the floor is yours.
Thank you very much, and good morning, everybody. First of all, let me thank the organizer for letting me present this paper. The slides are on. I don't know if you can see it. Okay. This is a jointly co-work with Professor Brogi, as she already said, and Professor Porretta. So we are a pink team, no gender balance at all, but at least it was a successful research because we published recently this paper on Journal of International Financial Management and Accounting. The title is Be Good to Be Wise, Environmental Social Governance Awareness as a Potential Credit Risk Mitigation Factor. So as you can imagine, this is focused on ESG and the relationship with credit risk by banks. Let me start from the abstract. In a nutshell, what we are doing here is looking for the possibility to integrate ESG factors into the credit risk assessment of banks. Basically, we measure the ESG awareness of companies by calculating the ESG rate of adoption of different policies related to ESG, as we will see deeply in the next slides. And we look for the relationship with credit risk as proxied by the Altman Z score and by the probability of default of companies. We have already heard by Lucia Alessi how much is important this topic from an authority's perspective, but we also have been inspired by practitioners. So basically, the motivation of our paper is summarized in this picture that is retrieved from the last survey published by Standard & Poor's Global Market Intelligence focused on ESG. This survey is it was addressed to both asset managers and bankers, so they are all practitioners. And as you can see, basically all the majority of them think that ESG plays a key role in the credit risk management of today. And you can see also the breakdown by countries that basically is the same in all the geographical areas. So it is a relevant topic, and that is why we decided to explore this issue. So our main research question is there a link between ESG factors, and ESG awareness, as I already mentioned, and the credit risk of companies. But we also have explored other sub-research questions. First of all, if there are any other sub-relationships that may be identified between the three different dimensions of ESG, so environment, social governance individually, and the credit risk. And also if there are any differences when looking at the sample breakdown by industry and country. And that's how we proceed. We base our research in a two-steps methodology. First of all, we create several scoring models to evaluate the ESG awareness of the companies, and then we use the obtained scores as independent variables to look for the relationship with other dependent variables proxying the credit risk of companies. We rely on MSCI ESG KLD stats database. That is a very granular database that provides information about all the three different dimensions, of course, of ESG. So in this particular database, we have binary information about the adoption of the different policies related to ESG. So, for example, in the environment section, we have climate change, pollution, waste, environmental opportunities policies. When the policy is adopted, the variable takes the value 1, and of course, when the policy is not adopted, variable takes the value equal to 0. Similarly, there is a high granularity of information for the social and governance dimension. So stay again on the sample of information that we collected. We focus our attention on more than 3,000 large listed companies. Of course, we explore listed companies because they are the ones for which MSCI provides ESG scores. And they are based in 719 countries in the world, and they operate in 19 different industrial sectors. The period of our analysis spans from 2000 to 2016. Below, you can see the descriptive statistics of our sample. If we start from the bottom, we have the overall ESG scores that spans, of course, from 0 to a maximum value of 1. When all the policies that are mapped by MSCI are indeed implemented. And then we have the breakdown by the three different dimensions, so the E score, the S score, and the G score. And we will see in a while how we calculated these different scores. Lastly, we have the Z score that is our proxy of credit risk that was calculated by retrieving data from the Bureau van Dijk Osiris database. And let's go to the model. On the one side, we have our dependent variables. On the other side, we have our covariates. On the dependent variables, as I already said, we use the classic formula provided by Altman of the Z-score. So you see the classic calculation of the Z-score with all the figures coming from the financial statements of the companies in our sample. And then we also checked the robustness of our result by using the probability of default of the companies. That follows the formula introduced by Vassaloo and Singh in 2004, that in turn is following the Black-Scholes formula. As for the ESG scoring, we decided to use a very simple approach to compute our scores. So you can see that they are simple averages on the different binary variables that we mapped from MSCI. So, for example, for the E-score, we calculate the simple average of the different environmental related policies adoption, and then we calculate the ESG score by again calculating the simple average between of the different subscores, so E, S, and G. This is because in this case we decided to do not apply a discretionary different weights for different aspects of our ESG scoring methods, in order to catch the differences between, for example, different industrial sectors. Because for one, we can have more importance for the environmental dimension, and for other, we cannot have it. So having all the weights equal make us to better understand the importance of the different dimensions. Coming to the model, we used a set of panel regressions with different methods. First of all, we used OLS regression models. Then we use fixed effects and random effects regression models. The covariates, as I already said, are on our first attempt the ESG scores overall, and on a second attempt we used the ESG dimension individually. We do not apply any other covariates because otherwise we could have an issue of a collinearity bias that may be related to some variables included in the Z-score calculation, because as we saw from the previous slide, the Z-score calculation implies a very large set of variables coming from the financial statements of the companies. And so these were our models. Coming to the first results obtained from the OLS specifications. This is the table of the result using the Z-score as dependent variable. As we can see, we have a very strong relationship that can be identified between the ESG score overall and the credit risk proxied by the Z-score. It is, of course, maybe it's better to say, as we could expect, it is negative. So it means that the more the company has adopted a strong set of ESG policies, the lower will be the credit risk associated with that company. And also, if we look at the different subscores relationship, we find again strong significance and negative correlation between the two different side of the equations. In the first two models, we do not use fixed effects. In the other two models, we used year, industry, and country fixed effects for controlling for all the potential biases that can emerge from the specifications. These relationships are partially confirmed by the implementation of fixed effects and random effects regression models. In particular, we do find a strong and significant relationship between ESG score overall and credit risk. But in this case, we find as a significant relationship only the social score. So this is the most important in predicting the credit risk when looking at the different subdimensions of the ESG score. But again, the ESG score is very strongly associated, so our results still hold. When we pass to the probability of default regression models, we run this set of regressions to check if the Z-score was a reliable proxy of our credit risk. Using the probability of default indeed confirms our results, because we still obtain negative and strongly significant results when looking at the relationship between ESG score and credit risk, this time proxied by the probability of default. And again, we find a strong and significant relationship between specifically the social dimension of ESG and the credit risk. And this is for all of the models that we have implemented. Now, looking at the breakdown by country, we can find some differences in the in the power of the relationship between the variables. And for US, we find strong significance for the environment and social dimension. ESG is relevant for US overall, and also for the European-based companies, we find, and for Asian companies, we find that in this case the environmental score is very, very important. This is slightly different from the results that we saw before, because we have a lot of companies that are based in US, so probably the results obtained in this case, so that the social dimension is the most important when looking at the relationship with credit risk, is because most of the companies are based in US, so that is why. But it's interesting to see the differences in the breakdown by country. Similarly, we also provide the results breaking down the sample by industry. And in this case, we find that ESG is relevant when we investigate manufacturing, oil and gas, construction and transportation companies. But it is not so relevant when we look at services, real estate, utilities and wholesale companies. Maybe because in this case, the topic of ESG is still not so, let's say, mature for this type of industries. So there are also here some interesting differences that we can observe. Then, again, to stress out the reliability of the results, we decided to calculate an instrumental variable that is used to check the robustness this time of our independent variables, so of our ESG scoring models. The strategy of the construction of this instrumental variable is the one summarized here. So we run a factor analysis over the following variable that I'm going to explain you. And we used a principal component analysis for the data reduction. As we followed from the main literature on this topic. The computation of these instrumental variables lead us to identify just one factor that represents our instrumental variable, so our variable of interest, so the ESG proxy that we saw in the previous models. In detail, the variables that are used to construct the instrumental variables are the GDP growth rate that is used as a proxy of the environmental factor. Then we have the Gini index that measures the extent to which the distribution of income among individuals deviates from a perfectly equation distribution. So it is a proxy of the social factor in this case. Then we have the variable school, that is the enrollment ratio, regardless of age, to the population of the age group that officially corresponds to the level of education. So again, here we have a proxy of the social dimension of ESG. Lastly, we used the rule of law that captures the perception of the extent to which agents have confidence in the roots of society. So in this case, this is a proxy of the governance dimension of ESG. We run our PCA, and then we test for the reliability of our instrumental variables. As you can see from the first table, we have that in that table we have our dependent variables is the ESG score overall that we already have calculated, and we can see that all of the single variables that we have decided to include in the instrumental variables calculation are strongly and positively associated. That means that is fair to use these variables as proxy of our ESG score model. And after having calculated the factor with the PCA, we can see that, again, the factor is strongly and positively associated with the ESG variable that we already implemented. So it's good to use this factor in our regression models that we already presented. And coming to the second table, that's what we do. So we used the factor, the instrumental variable as calculated above, instead of our ESG overall score. And we can see that in this case, we have that the factors, the constructed factor is strongly and again negatively associated with credit risk. Proxied in this case by the Z-score. What does it mean? That the hypothesis that we drawn down in the very first slides still hold, because the instrumental variable that substitutes the ESG score overall, again, is negatively associated with the credit risk. So again, the higher will be the ESG awareness, this time proxied by the instrumental variable, the lower will be the credit risk of the company. So we can answer to our research questions already presented, and we do find a link between ESG factors and credit risk, proxied both by the Altman Z-score and by the probability of default. The use of our instrumental variable is supporting the reliability of our model, we confirm our result by looking at the different subscores, and we also can see and comment some differences that can emerge when looking at country and industry breakdowns. So we provide, at least we try to provide new evidence to support the effectiveness of the integration of ESG factors into the credit risk management of banks. So in this case, ESG awareness can be viewed as a potential risk mitigation factor. Of course, there are some shortcomings that have been and still have to be addressed in the paper. First of all, we have endogeneity and causality that is a classic shortcoming in this kind of research, and we tried to address this issue in the both side of the regression models, so by checking for the robustness of the Z-score with the probability of default, and by checking for the robustness of the variable of interest, so the ESG, by constructing our instrumental variable. There is another issue coming from the sample selection, because as we saw is slightly unbalanced because we have a lot of companies based in US. So probably we need to explore a little bit more the sample selection criteria, and maybe explore more the differences between different countries. The methodology that we presented is the classic methodology, but we confirm our results by looking at how the findings still hold by implementing different kind of regression models, but we can also try and look for the application of non-parametric models, and also by applying 0-1 inflated regression, because as we saw from the descriptive statistics, the ESG scores that we calculated for the different companies in some cases are mostly equal to 0 or to 1, depending on the adoption rate of the different ESG policies. Lastly, we used data coming from MSCI, but there are some other rating providers, and we know that in some cases, or better, in most of the cases, the ESG ratings assessed by the different providers are not always consistent, so we can try and run our regression with different data. And now we are researching again for investigating the different geographical areas findings and industrial sector findings, and the role of disclosure and reporting framework as mediating variables of this kind of relationship, so between ESG and credit risk. Thank you very much for your attention. If you like this presentation and you want to see more results that have not been presented here for time constraint, this is the reference of our paper. So that's it for me. Thank you very much.
Thank you very much, Valentina, for this presentation. I'm going to leave the floor immediately to Professor Giuseppe Torluccio, who is going to provide us with the discussion of the paper.
Thank you, Marina, for inviting me to discuss this paper, and thank you to Valentina for your presentation. So this paper is already published, so I just give you some possible suggestion to explore a new potential paper that you can get from the idea of the first one. And I would like to give some suggestion also to some students to get some useful insights from this paper to different report or some kind of work they have to produce for different classes. So the topic is very relevant. As you know, already it's almost impossible to find something that is not related to ESG ratings in financial markets, in the UA taxonomy, in banks, in small and medium enterprise. So it's very, very useful to get in touch with a different methodology and get in touch with the relation between ESG ratings and other measure of risk. This score is one of them. So the paper, as we discussed before, use ESG scores, use 79 countries and 19 industries. They use large number of econometric techniques to explore one of the possible potential large problem related to the endogeneity or the causality between credit risk and ESG ratings. So we have more than 2,000 listed companies. In some sense, we have more than 3,000 companies. We use in this paper a specific ESG rating. The ratings are provided by MSCI, so it's pretty common, useful providers of ESG ratings, KLD. As we mentioned in the paper, the authors mentioned in the paper, of course, we can use different kind of rating agency because, as you know, there's a large number of ESG rating providers with a different methodology, with different structures, as we can see in the next slides. So the question is relevant for the literature, and we can see different papers that try to explore this topic from different point of view. They use two steps methodology, and they try to create a relation between ESG index and equally weighted three scores, so environmental, social, and governance. We use the paper used different kind of regression models to try to identify a relation between these scores. Maybe they can also use some kind of little bit more complicated score called a theta score, or they can also use another kind of score. It's called Olsen score. We prefer Olsen score because it's less related to market value, and usually we use Olsen score for small and medium enterprise. Could be interested to check also the robustness with other index related to the Altman idea that's called this score. And you can use another technology to check the robustness of the paper using Merton approach, so the distance to default. But of course, we need different kind of data, not very easy to get, but a Merton approach could be also useful in this case because we need market data, so the volatility of the stock price and the leverage, so we can compute the distance to default using the Merton and option-based approach. The main findings is relevant. Why? Because finally we can see ESG score related to the credit risk. This assumption is very strong also for the at industry level. We have different rating providers in our country. CRIF is one of them, Prometei is one of them. So they try to design different products that get in touch firms, credit risk, market positioning, and ESG scores. So I think can create also some kind of opportunities for students to be explored in the next month when maybe they're looking for a job in the industry, because this topic, ESG and credit risk, are very, very, how to say, promising market for consultancy and also related to the methodology, how to develop new models to get in touch ESG and credit risk. I can suggest also to do some kind of tests, as we mentioned before, using Merton approach, because you don't need a large number of information. And if you have market data, you can use Black-Scholes model to define the distance to default and also another possible measure related to the credit risk. In this graph, I want to just show how can be different the rating, the ESG ratings, when you get from different ESG rating agency. So we can see some companies on the left side of the slides. So there are kind of convergence between ESG ratings from different rating providers. But at the opposite, on the right side, you can see large difference between different raters related to different companies. You can see, for example, Intel on the top, on the right, you can see a very different evaluation from Sustainalytics, KLD, the rater that the authors used for the paper, MSCI, and so on. And here you can see another very famous table that you can get from the paper mentioned at the bottom of the slide, where you can see the correlation between ESG ratings between different raters. Main comments to the paper: the literature is covered, so you can get good information, good pictures of the state of the art of the literature. The motivation, the contribution is relevant for the academic people, but also for the industry ones. And I can suggest this suggestion is addressed to the students. When you prepare descriptives, when you can describe different kind of data set, I suggest you to include median value, not only the mean, because sometimes we have relevant outliers. And as you can imagine, you can get very different results if you consider or not consider outliers. You can use different technique. Windsorting is one of them. But in the descriptives, I always suggest you include at least the median value. If you wanna go deeper, you can also use quantize, or if you want to be very effective and you have room to do that in the paper or in the report, I suggest you include box plot, because immediately can give you the taste of the distribution, so you can get immediately what can be the relation between different components that you can use in your analysis. The future research, you can use different ESG scores, of course, so you can test with different raters, and you can also see maybe some interesting features between different kind of ESG methodologies. And another interesting issue could be related to the banking system. As you know, the banks now are dealing with ESG. They are not very familiar with these kind of measures because they are more concerned for the credit bureau, different kind of information strictly related to the credit risk, strictly related to loss given default and risk-weighted asset. So if you can get in touch with some data, banking data, you can also develop a really interesting feature of this paper for the credit system based on the banking system. So of course, it's not so easy because you need private information related to single loans, but could be very fruitful to relate ESG ratings to the internal ratings. Thank you for the paper. I learned a lot from this paper, and I suggest all students to read the literature. Maybe the econometric stuff is a little bit more complicated for them, but you can get useful insight for future research and reports and material useful for your thesis or dissertations. Thank you, Marina, for the invitation, and thank you, Valentina, for your beautiful presentation of the paper.
Thank you very much for the very useful comments.
So thank you very much, Giuseppe, for your insightful suggestions regarding the research, and especially, if I may, for your expert guidance for the numerous students and younger researchers in our audience. I must say that I fully agree with you. As Valentina Lagasio knows, I believe that a savvy table on descriptive statistics is indeed very important. And it's something that sometimes younger researchers forget, but it's a way to understand where the outliers are. If you have data which is missing, it's very important. It is the real starting point. So for me, great suggestion. And for students, we have numerous of them I see over 200. Please abide with the guidance that you have received today. So let me.
If I can add something, in some sense, we are very jealous of Valentina's age, and we discovered that from descriptive statistics because they miss a median value. Thank you, Valentina.
Rightly so. So I'm sure that, that we have a Q&A session imagined right at the end of the of both presentations. So I thank you both again, and let me now pass the chair to Skiadopoulos, Professor Skiadopoulos of Piraeus University, and I believe he has joined us. I can't see him. George, here. Hello, welcome.
Hello. How are you?
Very much for accepting our invitation. The floor is yours. We look forward to the presentation of this very nice paper.
Thank you very much for inviting me. It's a pleasure to be here, and sorry for not being able to attend the previous sessions because I was on another meeting, so apologize for that. So let me share my screen. I see something in Italian here, but let me check. Okay. Let me navigate myself. All right, here we are. Okay, I hope you can see my screen.
Yes, we can. Please.
Thank you. Should I budget something like 20 minutes for the talk?
Yes, please. That's right.
Thank you very much. Thank you. So this is, once again, thanks a lot for the invitation. This is joint work with Renato Faccini and Rustin Matain from the Central Bank of Denmark. And as you can tell from the title, the paper is about measuring climate risks and whether these risks are reflected in stock prices. So let me briefly give you the motivation for this work. As we all know, market-wide climate change risks are multifaceted, so they can be dissected in physical and transition risks. And there is a big question here whether stock prices reflect these risks. Now, the answer is not obvious, judging from previous literature. So on the one hand, we have survey studies or high transaction costs for decarbonizing portfolios, or the fact that decarbonization may not pay off, which support the idea that stock prices do not reflect the risks. On the other hand, investors may be sensitive to short-term effects. So furthermore, there is an even more interesting question, and that is whether physical or transition risks are priced. So if climate risks are priced, is it physical or transition risks which are priced? Now, there are two camps on this. One camp mainly comes from policymakers. So for instance, Christine Lagarde says that physical risks are not priced, and therefore there is need for government's intervention to correct this mispricing so that to avoid issues with financial stability. The second camp says that physical risks are not priced, and government's intervention is going to be priced by its very nature. However, there is no need for intervention. So here we have people from, say, BlackRock or John Cochrane from academics support this view. Now, there is no previous literature on whether physical or transition risks are priced, and that's exactly where we're going to step in. So what we do in this paper is we're providing first-time evidence on what types of market-wide climate risks are reflected in US stock prices. So we're not considering here firm-specific climate risks, but market-wide risks. What we're going to do is to dissect these market-wide climate risks by textual analysis. And to this end, we're providing novel measures of market-wide physical and transition climate risks. And then we examine whether these are priced, and we provide and validate a possible explanation for the results. Furthermore, we document which firms are the most exposed to these risks. So a few words about the dataset. The dataset comprises Reuters news spanning 1st of January 2000 up to 31st December 2018. We have more than 13 million articles from Refinitiv. We screen these articles by looking for two keywords, climate change and/or global warming, and after all, we retain 34,000 articles. Moreover, we are going to employ the usual suspects, if you like, so US common stock returns and characteristics from WRDS, equity risk factors from authors' websites, and the score from Refinitiv. The method we are using to quantify the climate risks is a textual method called latent Dirichlet allocation. What the method does is it decomposes the entire textual corpus into K topics. So this K is defined by the user. For instance, we define K to be 25, and then the method decomposes this news. It classifies this news into words, into these 25 topics. So each topic, little k, is a probability distribution over unique words. And the second thing that LDA does is it estimates the so-called topic shares. So what is a topic share? It is the percentage of a given article associated with the respective topic. So you can view the article as a probability distribution over topics, and the interpretation of the topic share is the intensity by which a topic appears in any given article. So as a result, our climate risk factors represent the intensity of news coverage of a given topic on that specific day. So we have values for these climate factors at a daily frequency. Now, from the analysis, we identify 4 topics. First, natural disasters. Second, global warming. Third, international summits. And fourth is the US climate policy. Let me give you a picture to see what we mean here. So each topic is a bag of words. For instance, this topic 23, this is the 23 number topic. You see the bigger fonts indicate that the words which have bigger fonts come up with a bigger frequency in this bag of words. And this enables the user to label the topics. So for instance, here you see that the words which are coming up more frequently are, for instance, weather, warm, heat, disaster. So we label this topic as natural disasters. Let me give you another example. Here we have something that we call US climate policy at a state level. So remember, all these words are related to climate change by design. So you see here use, legislation, standards, California. So this is part of the US climate policy at a state level. And then we have another topic, which is US climate policy at the federal level. So you see here Republican campaign house, etc. So we take the union of these 2 topics to define the US climate policy topic. Let's see how our climate policy, our climate factors look like. So for instance, here you see the natural disasters factor. Remember, spikes indicate that there is a bigger intensity of news coverage on this given date for this specific topic. So you see that the intensity rises whenever certain events are happening, like for instance, wildfires in California, floods in Africa, record-breaking weather, etc. What do increases in the factor signal? Well, they signal bad news for the economy, because whenever natural disasters come to the attention of the media, this is because something bad is happening. And typically these are risks which have some sort of long horizon effects. Similarly, here we have the time series for the global warming factor. So again, we have spikes whenever we have releases of certain scientific reports. Again, increases in the factor signal bad news for the economy. Then we have the international summits factor. Again, you see that we have spikes whenever certain international summits are happening. You see, surprisingly, that the Paris Agreement here, in contrast to what one would expect, receives a rather low attention from the media. This is because the media had already paid attention to the Paris Agreement well before that. Now, increases in the factor signal bad news for the economy. In what sense? In the sense that typically in these meetings, we have discussions about taxing polluters. So taxation is, reduces welfare. So by economists, this is regarded as a bad thing. finally, the US climate policy factor. Again, we have spikes whenever certain events are happening in the US Congress. Now, the interesting thing and the challenging thing actually with the time variation of this policy factor is that increases may signal either good or bad news for the economy, depending on which party is conquering the House and the Senate. So, for instance, you see here you have a spike when US abandoned the Paris Agreement. This is over Trump's administration, but this signals good news for the economy in the sense that no taxation would have been imposed on polluting firms. On the other hand, we have spikes here over Obama's administration. This signals bad news for the economy this time because the Democrats were, at least when they had the power, they were taxing the polluters. So this is something to keep in mind for the remaining of this analysis. Now, coming to the asset pricing test, let me keep also track of time. I believe I have another 10 minutes. So coming to the asset pricing test, we have a cross-section of stocks at any point in time. And what we do is we estimate the climate beta for each stock with respect to any given textual factor F. So we run a standard time series regression for each stock by controlling for a set of standard factors which are included in this X vector. So at any point in time, we estimate the climate beta for each stock, and then we sort stocks in portfolios, either decile or quintile portfolios, based on their climate beta. Then what we do is, given the sorting we have done, is we calculate the monthly post-ranking portfolio returns. These are value-weighted returns, portfolio returns, so that to avoid any data mining issues. I should say in advance that the way we estimate these climate betas are through rolling beta regressions using the past 3-month daily data. So once we have computed the post-ranking portfolio return, then imagine if we have done, for instance, the short in 10 portfolios, we compute the so-called spread portfolio return by taking the difference of the return of portfolio 10 minus portfolio 1 at any given point in time. And then we continue with the rolling window estimation. So we estimate the climate betas at any given month. We do, and we repeat steps 1 to 3. So eventually this gives us a time series for the post-ranking portfolio returns, spread returns, and then we are going to estimate the alpha of the spread portfolio. Now, evidence of a non-zero alpha, which is statistically significant, if statistically significant, will indicate that the factor is priced. So if the alpha is 0, then this is evidence that the factor is not priced. And we're using alternative models to estimate the climate beta and alpha to ensure robustness. So let's see what we find over our full sample. Here you can see the results for the decile portfolios. So here you see each panel represents a different model to estimate alpha. And so you see here, whoops, what has happened? Can you see my screen?
We can see you, yes, sharing your screen, but not the presentation.
Actually, we seem to be seeing another screen as well. Yeah.
Let me reshare. Because I also see another screen here. I don't know what the screen this is.
I have no idea. It's not mine.
It's not mine either.
Fortunately.
Yeah. Yeah, we have a thing.
I think now we see your screen. Our factor
Okay.
January 2000, December 2018.
Okay, great, thanks. So we had a cybersecurity attack.
Indeed, indeed.
Right, so what you see here are the alphas of the spread portfolio, sorting with respect to the natural disasters or respect with global warming factor or with respect to the international summits or with respect to the US climate policy. What you can see is that the alphas are only significant for the US climate policy factor. So this is the alpha on a monthly basis, and you can see that this is positive. So why is it positive? Why is the alpha positive for the US climate policy factor? So we provide an explanation here, which has to do with intertemporal hedging. So what is the idea? Let's conjecture, for instance, that a decrease in the US climate policy signals an increase in transition risks. Then this is bad news for the economy because transition risks have increased, and this deteriorates the investor's opportunity set. So as a result, investors would like to hedge this risk. And to this end, what they are going to do is they're going to buy stocks which have a negative textual climate beta, and they're going to sell stocks which have a positive textual climate beta. So by doing this, basically, this is going to increase the price of the stocks with a negative textual climate beta. Therefore, it's going to decrease their expected return, and the reverse for the stocks with the positive climate beta, and this explains the positive alpha we get. Now, to verify this explanation, we need basically to check that our conjecture holds. So how are we going to do this? We're going to do it in two different ways. First, via subsample analysis, by choosing an appropriate sample period where we know that a decrease in US climate policy signals an increase in transition risks, and then more formally by reconstructing the policy factor by marking the content of news so that we know exactly what the factor fluctuation signal. So let's look at what we get from the subsample analysis. We take as a splitting point the November 2012. Why is that? Because after November 2012, the Democrats, even though they were in power, they had lost the majority in the House of Representatives. And after 2014, the Democrats also lost control of the Senate, and eventually Trump took over in November 2016. So what you see here is, again, you see the alphas for the various models obtained from a subsample analysis. So before 2012, regardless of whether we're sorting stocks in decile or quintile portfolios, we see that the alphas are insignificant, whereas over the post-2012 period, the alphas are significant. So this is in line with the hedging argument we have put forward. Now, something which is also very, I think, very interesting for supervisors like Consob is the following. We check a bit the characteristics of the stocks which are in these 5, say, portfolios, right? So what is our story? The story is that the investor, if the investor holds a portfolio of 5, this is the portfolio which is exposed to climate risks, and the investor wishes to hedge these climate risks by taking a position in portfolio 1. So you would expect that the stocks which are most exposed to climate risks are brown stocks, so the stocks of polluting firms. And actually, if you check the E-score, so this is the E-score from Refinitiv, indeed you see that the E-score of portfolio 5 is much lower than the E-scores of portfolio 2, 3, and 4. But interestingly, very interestingly, portfolio 1 also has a very low E-score. So what this says is that according to our story, investors hedge climate risks of brown firms, not by using green firms, but they're also using brown firms. So why are they using brown firms? Well, if you check then the change in the E-score, now this time you see that the stocks that the investors are using to hedge their climate risk exhibit the highest increase in E-score over all other portfolios. So what this tells us is that investors hedge climate risks by using brown stocks. Nevertheless, these are stocks of firms which show a strong intention to improve environmentally. Actually, this result was at the first sight surprising, but then we talked to various hedge fund managers, and they told us, for instance, we talked also to institutional investors like Allianz. And actually, they said to us exactly the same thing, that they observed that their clients are hedging climate risks by using brown firms, which show an intention to improve environmentally. I think this is very important for policymakers, so I'll come back to this point in the conclusions. Okay, so in the last I guess I have 1 minute only. So let me very briefly tell you about the narrative factors we construct. So basically, we select articles with a topic share on the domestic policy factor, which is greater than 40%. This gives us 3,500 articles. And what we do is we read each article. So this is a very time-consuming process. And we mark it with +1 if it signals an increase in transition risks, -1 if it signals a decrease in transition risks, and 0 if its content is mixed. And then we take the narrative factor value as the sum of the marks given to the articles on any given day T. Let's see how our narrative factor looks like. Remember, decreases in the factor, like for instance, we see such pronounced decreases over Trump's administration, signal that the US climate policy risks signal good news for the economy, whereas increases signal bad news. This is exactly what is happening over Obama's administration when the Democrats had the power in the Senate and in the House of Representatives. So if our hedging story is valid, then we would expect to get a negative alpha when we sort stocks with respect to this climate policy narrative factor. And that's exactly what we find. Again, you see here the subsample analysis and the full sample analysis. So over the full sample, you see that our alphas are negative this time. And then again, we get a negative alpha post-2012, meaning that climate risks, the pricing of US climate policy risks is a rather recent phenomenon. It has started occurring post-2012. So to conclude, what we have done in this paper is to dissect market-wide climate risks in its multiple sources. We examine whether these are priced in US stocks, and we provide and validate an explanation, that of intertemporal hedging. How about the results? We identify 4 market-wide textual factors with a clear interpretation. Only the US climate policy is priced, and this evidence is driven by the post-2012 era. What are the implications? Well, for a start, we see that physical risks are not priced. However, when the government decides to intervene, then this has pricing effects. Climate policy risks have started to be priced only recently. Investors reward firms which improve their environmental profiles. And actually, in a way, this is the first study which verifies the starting point of the 2 camps I mentioned at the very beginning. So when Lagarde was saying that that natural disasters, for instance, are not priced, how did she know this? Well, she didn't, but our research now verifies her claim. When the CEO of BlackRock was saying that the investors are not pricing natural disasters, well, how did he know? From a scientific perspective, this is the very first study which verifies this, and it can be used, we believe, by policymakers so that they can, they have a justification for policy intervention. Now, an interesting question, of course, here is why are not all risks priced? Is it, for instance, that investors have a short-termist bias? Is it, for instance, that the regulators, policymakers, do not provide enough information to investors so that they start pricing the risks? Or is it that John Cochrane is right when he says that, okay, climate risks are of course important, but we have also other types of risks which potentially are more important, like for instance, nobody could have expected, for instance, the effect of COVID, or even, Cochrane says that, sometime in the future a meteor may fall on Earth, for instance. So that's all I had to say. Thank you very much for your attention and time, and look forward to further discussion. Thank you.
Thank you very much, George. I must say I cannot not pick up on one of your points. Lucia Alessi, before you joined, in her comprehensive and detailed policy speech, started off by pointing out that transition is one of the key ingredients in the EC renewed sustainable finance strategy. And I think, your point 3 regarding the fact that investors tend to like companies which have a transition plan in place is one of the things which I think is very true, and it's very savvy. And so I just wanted to point this out before passing the word to your discussant, Anastasia Giacomello. I must say, two very complicated and long Greek surnames. Quite tough. From Università Ca' Foscari. Anastasia, thank you very much. And thanks again to George. The floor is yours.
Thanks to you, Professor Brogi, also. Thank you for the invitation today. Thank you also for this chance to meet another Greek, even if it's going to be virtually and we're going to be speaking to each other in English. I'm going to start sharing my presentation, although I'd like to make some basic premises. Can you just confirm that you can see it?
We can see it, yes. We can.
Excellent.
It's not in presentation form. Great.
Okay, let me go on full screen so that I don't get any. When I talked about basic premises, it was, first of all, it's always a pleasure to read such interesting research, although we have a pretty hefty track record for Professor Skiadopoulos. But also it's pretty interesting when you're a discussant because you can skip some of the technical, boring stuff, especially for students, I mean, not among us, and make some useful points. And this was one of these occasions, this paper. It was beautifully written, long and thorough, also on literature, on the analysis part. I'm going to make some comments in a bit. I loved the machine learning approach. I love people that adopt, and I think it's highly fruitful for finance by now, given the new technologies also within the industry. But it's always useful to go through new approaches, especially because ESG has proven a bit difficult to tackle from certain perspectives. This was an amazing paper for me because it gives me 2 points of to ponder on. Let me go through a very, very fast executive summary of my take and the topic, which is actually already a big void they try to cover through their research. They adopt textual and narrative analysis, as you've heard Professor Skiadopoulos already elaborating on both physical and transition risks market-wide as a perspective adopted in the research. We already witnessed a dissection in 4 types of events, of risks that could eventually be priced by the market. We saw natural disasters, we saw global warming, international summits, and specifically US climate policy, since it was targeted on the US equity market. What we saw immediately after is that the market actually only cares or prices, at least currently, shifts in the policy. And this is what I will be mainly commenting on and discussing, because I would love also some further opinions from the author himself. Many strong suits. I tried to summarize them here so that I don't waste too much time of the presentation, that I'd like to keep as concise as possible. A really excellent and thorough literature review. I highly recommend the paper also for who doesn't have a very deep understanding of climate risks, climate finance, new products in the market so far. This is a very good starting point, even for people that don't have a robust previous experience. Well-grounded hypothesis. I got a very clear feeling where the authors parted from. The topic is more than relevant. It's relevant for actually a long series of participants, from us academics, students and future entry-level job market participants, regulators, investors. They employ, and I think that was underestimated in the presentation by the author, a very beautiful, vast sample. They have a very heavy handmade component. I think they elaborated some 1,000 articles tailored in a tailored manner when in a secondary analysis. They provide an excellent, robust econometric analysis and an interpretation of the findings of this research. So that gives a lot of ground for discussion on several aspects. Some methodological comments, although I would like to keep them to a minimum, first of all, because it's honestly an excellent paper and I don't have any weaknesses to highlight, let's put it this way. I have some curiosities, if I may. I know that you had a textual search based on the keywords of climate risk and global warming that you passed through the LDA. I was just wondering, especially since you focused on the US equities, whether you might have omitted some significant shifts that we had towards the opposite direction. And let me be more precise here what I mean with the opposite direction. We all know that there was the intermittent Trump administration during the time horizon that you were analyzing. And there were a lot of events in terms of policy making that were affecting specific industries, in particular renewables, big oil and gas. You know that they opted with a lot of decisions for American energy autonomy, giving back power to the oil and gas industry, taking back, they had something only in the first year and a half, I think there were more than 100 rollbacks on policy and some tax relief efforts for renewables. And some tax incentives and state help for oil and gas that were previously withdrawn by the Obama administration. I was just wondering whether you missed some events in the market that didn't necessarily include those keywords, but could have provided useful signals and useful information for your model specification more ahead in your study. Then some brief comments, and I wouldn't like to call them questions or doubts. It was more, although I saw some explanations already by Professor Skedopoulos, you had a very nice, you presented us with a beautiful analysis on the specific events that were relevant in terms of climate transition, climate risk and perception, all through this period that you were studying. You had this determining point of 2012 that you also pushed some subsample breakdown on. I was wondering that, notwithstanding, I know that you adopted a non-parametrical analysis, so that tackles a lot of issues towards this direction. But I was wondering whether or why, if you have a specific explanation, some key turning points are not that much focused on, or whether there's an explanation that you saw and decided to eliminate them as a turning point in your sample distribution. You briefly commented the Paris Agreement in 2016. Maybe it was an issue also with the signatories joining in. I think it was the 1st of April for US. I was more concerned with not seeing any effect when the US withdrew from the agreement in 2017. Well, it was a bit of a shock, and I have seen some papers discussing it in terms of some event studies on specific industries, given that this paper had some major focus on great polluters and greener equities. Then we had the UN SDGs that were pushed forward in 2015-16. They were formalized with the 2030 agenda. I'm sorry, that went on. So I wanted to understand a bit better, and I think there's much to be discussed on how specific events were omitted, were overviewed probably by the market, or it was specific industries that had probably a reaction to those. I think that has some merit to look into with some more detail. This second aspect of methodological, not concern exactly, but point of discussion, primarily I wanted to bring forward was also the materiality considerations. You focus on climate, and you focus on environmental performance of the equities that you include in portfolios in terms of hedging mechanisms. you are using, I think, Refinitiv ESG scores. I know that you didn't have any industry specification. Then you come out with climate betas. So I was just wondering if we do not proceed. I know that the ESG scores, and our audience should take a couple of comments on this. Probably it would be of extra value. All scores tend to have some intrinsic materiality.
In Ischia. Ma come? A te Ischia non ti è mai piaciuto, amore?
We have an
Che pensata a Ischia?
Please put your mute on.
Sorry, there is someone with the mics on. Could you switch it off, please?
Please check that you are muted. Perhaps the organizer can
Devo
mute.
andare in Sardegna? Con Francesco di Zalella?
So this is the beauty of webinars. That you sometimes get curious. Is we had our 5 seconds cyber attack, and now we have, the muting problem. This is a typical thing. So we're great. We're done. Anastasia, the floor is yours again for I think your very final remarks, because you're basically out of time. Please unmute. Anastasia, unmute. Have we all been muted?
No, we can. I can hear you, Marina.
Okay.
You can hear me probably now.
Okay. Okay. Fine.
Yeah, I don't know. I think it was on mute automatically. My very final remarks. I think you can see my presentation again.
Yeah.
I was just wondering, in terms of materiality, was there some extra consideration that you gave to it? Materiality meaning we know that environmental concerns are more relevant for some companies, less relevant for others. I mean, if you're industrial, you have a certain impact. If you're a bank, you have almost no impact. So was there any consideration? Because if we don't make any materiality considerations, wouldn't the rational asset manager or individual investor could just diversify and hedge by basing the diversification policy on purely low beta, climate beta industries altogether, cutting out brown industries completely? I'm just going to wrap up with my comments on the conclusions, which was my favorite part of the paper, because it gives some food for thought, important food for thought. You identify, and I agree, and I think everyone agrees by now, it's pretty much consensus, that there's mispricing on climate risks in the market. It is to be expected. I think it's still pretty early on. However, you identify 2 potential mechanisms. You attribute it to 2 potential explanations. One could be that the market still lacks some symmetry, information, and sophistication. So policy, as a result of that, can become a secondary and camouflage signal. So investors can use it to see where we're headed. So based on policy, we can figure out how much is hedged now centrally, or how much do we need to do individually. Mispricing mechanism B, the alternative explanation would be, I put my money and I price right now on equities policy exclusively, because that's where I actually find any cash flow impact. If I don't price climate risk per se, maybe it just means either I don't see it, or I don't see any impact on those equities or on the market as a whole, or I see it too far down in the future. It's so discounted today that it's actually marginal to my pricing on equities today. I was wondering and thinking a third alternative, it could be that this vast lack of standardization that we have creates a sense of a lack of safety or predictability that creates confusion and impossibility to really price things right now in the market. Also because, and it's my final comment, as Professor Alessi, I think, commented briefly, but also Professor Torlucci made some very interesting comments on this regard. We have scores that provide different indications, maybe not with extreme divergence, but we still have it. We don't have too many things that are compulsory, at least for the time being. They are now being introduced. So I don't know how much we can see these risks reflected really for how many of the companies and what exactly we are expecting out of companies to tackle climate risks. Just to make an instance, banks cannot really be, or intermediaries or service companies cannot be really evaluated on their ESG performance with existing scoring, because even if you attribute low weights, the measures are still a bit off-leading. You could use probably, I don't know, their ability to issue specific instruments or integrate in their credit quality mechanisms specific criteria, but at least the current status quo is a bit misleading, I think. And this is a paper that highlighted a lot of these aspects. And I'm going to conclude here. Thank you again. I'm sorry if I probably stole a couple of more minutes. It was really a joy to read this work.
So thank you very much. Thank you very much for the discussion. We finished our time, but I think we may have time for a couple of questions. But before I turn to the Q&A, if we can have some comments, if you want to react in some way, George, regarding Anastasia's discussion.
Thanks a lot, Anastasia, for your kindness. We don't think we have a perfect paper. There is no such thing as a perfect paper, but very, very, very briefly and quickly, to apply any textual method, you need to anchor on certain words so that you ensure that the articles that the method reads are indeed related to climate change and global warming. That's why inevitably we have to make a choice. Now, regarding your other points, they're all well taken. So I don't mean to take any of your time. Let's see if there are any, questions from the audience. Thanks a lot again.
Yeah, and perhaps you can take it up on a bilateral basis. So thank you very much for being mindful of this aspect. Do we have any? Yes, I see that Nadia Linciano has a question. So let me pass over to Nadia. And if there are other questions, please raise your hand.
Thank you, Marina. I just want to make a remark rather than a question. First of all, to thank all the speakers and the discussants, because you gave a lot, you gave food for thought from the regulatory point of view. I think that as has already said also by Professor Karamowska, we really need inputs from the academic side. My view is that your papers, your discussion, once again underline the importance of public intervention. I know that this might be a biased view, but anyway, I think that it is quite well grounded in your works. For instance, Valentina's paper shows, I think that the results of the relevance of ESG scores with respect to Zeta score are mainly driven by the G factor and the S factors, which are probably, as we all know, the most heavily regulated by areas, by legislation, and that so that a breach of legislation in those areas, also in terms of transparency of rules of conduct, may have a material financial impact on firms and on their probability of default, on their credit score. And also George paper showing that physical risks are not priced. I mean, are again the signal that we really need transparency, legislation, standardization of information, which is something that in the end of the European regulatory flow will be actually be in place, at least in the European Union. So this is just a remark that a point that I think deserve to be underlined. Thank you very much again.
Thank you very much, Nadia. I think that I don't have any questions in the chat, so I think this is the best conclusion. I think it was a great morning of work. I learned a lot, lots of food for thought, and it's great to have, on the one hand, the regulators, the supervisors, and the academia sharing thoughts on what is going to be, I think, a key topic on our agenda for a very long time. So thank you very much to all. Thank you very much to students, and have a great Friday and an even greater weekend. Bye-bye to all. Ciao, ciao.
Bye.
Thank
you very much.
everybody.
Arrivederci.
Thank you. Bye.
Arrivederci.
Bye.